The stock market surged following President Trump's win, in part due to the expectation of tax cuts. But with that looking to be potentially delayed, could investor enthusiasm for this administration fade alongside it? For more, we've got Brett Nelson, the head of tactical asset allocation at Goldman Sachs Investment Strategy Group. Brett, thanks for being here. If we don't get tax cuts, how rough could that be for the market?
Well, I think that there is a spectrum of policy pejoratives of the new administration. And so on the one hand, we have things that are very market friendly, like, as you mentioned, tax cuts and deregulation. On the other side, we have some of the things that you were just speaking with Jonathan regarding immigration policies and what we do with tariffs. And so it's really a question of, how far that dial is turned in either direction. I think it's likely that there will be a focus on tax cuts and deregulation. It's a cornerstone of the Trump administration's policies. And so I think it would be quite surprising if nothing happened on that regard, especially just an extension. Whether we get additional tax cuts, that's a whole separate question, in terms of the corporate tax rate. But it seems likely that they are going to try to extend the tax cuts that were put in place in 2017 along kind of the lines of what the market is currently expecting.
But when it comes to how much optimism has been priced in, when it comes to just the overall degree, even beyond the tax cuts, your read just about how maybe caught off guard the market seemed to be when it comes to tariff, and maybe what that spells just about the downside risk then that lies ahead.
Yeah, so I think that, we expected there to be volatility related to tariffs this year, and certainly they have not disappointed in that regard. But when you step back and look at even the language that was in the White House's fact sheet, they used the word leverage 6 times, they used the word tool twice. And I think if we look at what's happened in the last week with Colombia, Mexico, and Canada, it seems like these are tools to extract some type of concession from our trading partners, as opposed to an end in of themselves. I think there was a lot of concern initially that these would be things that would be an end in of themselves to raise revenue and things like that. And it seems like they are more of a negotiating tool to get things that are important to the United States and our interests. Now, our view is when we step back from the tariffs and a lot of the volatility, at the end of the day, we think 2 themes that we've had for 15 years or so in the investment strategy group, U.S. preeminence and stay invested, are very much intact. And the reason U.S. preeminence in particular, we think, can weather the set of challenges that we're seeing is because these are things that are structural. They're not likely to change overnight. And what I mean by that is if you think about the U.S., for example, it is the largest country in the world. It is the wealthiest developed economy in the world, and it has the largest and deepest financial markets. It's the only country in the world that has all 3 of those characteristics and is in the top 10 of each of those. And that means the U.S. has a tremendous advantage in terms of how much it can invest in healthcare, R&D, innovation, the military, education, et cetera. These are things that are not going to change overnight, and they have persisted throughout many administrations in the past, rather than because of those administrations. And so we again focus on that because that really underpins our staying invested in U.S. assets. We have an 8% total return target on the S&P 500 this year. We think corporate earnings are going to grow around 10%. These are things that are likely to persist regardless of the headline noise we get around tariffs in our view.
8% sounds low to me, and I know I've been, spoiled by 2 years in a row of double-digit returns here, Brett. How do you think about your narrative of U.S. dominance staying intact and your bullishness on that with the fact that you've got a price target on the S&P that doesn't necessarily mean huge gains that I've come accustomed to?
Yeah, so it's a fair point that I think as investors, we know that there's probably some quantum of returns that the market has to offer relative to its fundamentals. And so clearly we've come through an environment in the last 2 years where we've had 20% plus returns in the last 2 years. That is obviously atypical. So I think it's very fair to say that it's unlikely we can sustain that level of appreciation. And one of the things we highlight in the report is that from the trough of the financial crisis in 2009, U.S. equities have delivered 17% annualized gains. That's obviously well above the historical average. So first and foremost, yes, you are correct. It's unlikely we can sustain those returns. But when you think about 8% in the context, you have to ask, well, how does that compare to my alternatives? And when we look at cash or bonds, we think those are around 4 to 5% returns. We're placing low 20% odds on a recession. Recession's the greatest risk to equity investors because that's where 3/4 of bear markets have come from. So if you have low recession odds, then you worry less about the defensive characteristics of cash and bonds. And then when we look at other equity markets around the world, we think that those returns are probably 6 to 7% versus 8 in the US. And if you're a US dollar-based investor, you're going to have to weather the fact that we expect the dollar to appreciate a few percent, which would drag on those returns. So on a relative basis, it is the kind of the tallest tree in the forest, so to speak, from our perspective, even though it will not deliver the type of returns that we've seen in recent years, to your point.
Guess you got to be thankful for what you could potentially get, and making that sound, I guess putting in context, 8% doesn't sound that bad. All right, Brett Nelson, great stuff. Thanks so much.